Hi, happy Friday. Approaching the end of earnings now in the last week of August. I wanted to do a video that I'd promised last week, talking about leverage, specifically leverage on the eToro platform, although some of the principles should be universal. For those of you that don't know, my name is Wes Nolte. Everyone calls me Wes. I am one of the top traders on eToro's platform. Been there for about 5 years. Returns have been upwards of 430%, not 430,000%. I have 97,000 followers and approaching 4,000 copiers. All right, so getting into it. On eToro's platform, some of the largest, some of the most popular investors, some of those that have been most successful, they tended to use leverage on their positions up until probably 2 years ago. And a lot of them have since pivoted to portfolios that are entirely unleveraged, one times positions and everything. But what I have been thinking recently is that potentially that's not the most optimal approach. And this will be controversial for a number of reasons, and I plan to address those in this video. So leverage, is it really the source of all evil, as you'll see a number of people talk about everywhere, investors everywhere, not just on the eToro platform. If you do want to get in touch and follow me on the usual social networks, and you can join my Discord using this URL. I will share this presentation in the links along with the video. So quite often the two biggest concerns, and there are some nuances, but the two biggest concerns with leverage is that you incur fees. So on eToro's platform, if you open an unleveraged stock position, almost always you won't be paying fees. You can hold that, keep it open for years, decades, and there'll be no fees. But if you were to use a leveraged version of that same asset, you will be paying daily fees in order to have that leveraged position. And there's also increased risk. And this is in a number of different ways. Volatile assets, they will be moving, if you have 2 times leverage, they'll be moving at twice the velocity, or 5 times leverage, 5 times the velocity. So it's very easy in a short period of time for your position to be entirely closed out. So to some degree, it means that you're trying to time the market, which is effectively impossible in the long run. There is risk in a number of different areas, and I'll talk about a few of those too. And just as an example of fees, so I've taken Amazon as an example, and I think I took the daily fee last week or earlier this week. So if you were to hold a position at 2 times leveraged and the position size was $500, you'd be paying $1.44 to hold that position for a week, and you would be holding nearly $70 to hold that position for 48 weeks, which is getting towards a year. So on the surface of it, it looks pretty damn expensive to be holding these types of assets if they're leveraged for a long time. 5 times leverage will mean that the fees are even higher than this. But the thing that really got me thinking was, who cares what the fees are if you're making more profit from a leveraged position? So here I have a similar example. So $500 position held for 48 weeks. The stock price ends up being $700. You've got no leverage, you've got no fees, so your profit is $200. Great, that's awesome. But if you'd done the same thing and leveraged that position, used 2 times leverage, your fees would be $69. And $69 as a proportion of $500 is enormous, right? So I can see why people would start becoming anxious about this. But the upside is that the net profit of this position is $331. So the fees are 17% of the gross profit, but your net profit is 66% larger. So net being the profit after all the costs have been taken out, 66% larger. And you've made a lot more money. So if you're just looking at fees, you might be like, oh my God, I paid this horrendous amount of money for this position. But if you actually did the accounting, you would know that you're better off for it. And I would argue that as long as you're making even 1 cent more from the leveraged position, it doesn't matter how big these fees are. If the fees was the same size as the original position, but you made more money from that leveraged position, who cares how much you paid in fees? You're making more money from the leveraged position. So what? So in order to dissect this a little more, and this is the kind of thing I do with almost every kind of trade, is I create models. And I've got lots of different kinds of models that I use to evaluate stocks. So just zooming in on this picture, the way that each of these graphs works is that everyone is showing the return of a 1 times position, an unleveraged position, against a 2 times leveraged position. And so this would be the net profit for the 2 times leveraged position over 1 week, 2 weeks, 4 weeks, 8 weeks, 12 weeks, 24, 48 weeks. If the stock rose by 5% over whatever that period is. So maybe that's a little bit complicated, so I'll walk through one, but every single one of these charts works the same way. So no matter the time period, even if it was 48 weeks, if I had a 1 times unleveraged position on Amazon and it increased by 5%, so I think these positions are all $500. So if it increased by 5%, I would make $25 off of that $500 investment, right? But if I had a 2 times leveraged position on Amazon that cost me $500 and Amazon rose by 5% in that 1 week, I would pay some fees, but my net profit would be nearly double. And so over time, obviously, I'm holding the position for longer, so the fees are accumulating. So my profit 2 times is $50. $50 minus the fees that I've accumulated over the 1, 2, 4, 8, 12, 24, and 48 weeks. So what you can see is that as long as my position, as long as the stock increases by 5%, within 12 weeks, I've still made more money despite the fees that I've incurred. And effectively, the next graph fixes all of the same variables, except now the stock price increases 10%. So now the gross profit is it's $50 for the unleveraged position in orange. The unleveraged positions are always in orange. And then I make double that, almost $100 if the stock price rises by 10% in 1 week. And you can see obviously that you're making less money, less net profit over time, because again the fees are increasing. And so I modeled that against a few different increases in the stock price. So you can see if the stock price for Amazon rose 15% over a year, you're still better off paying all of the fees for the 2 times leveraged position, because you're still making more money despite the pretty large fees you'd be paying at that point. And at 20% profit for Amazon, which is not unheard of. Amazon can easily double its share price in a year these days. You're making a hell of a lot more profit, right? Even over 40, I've only gone to 24 weeks here, but I think even at the 48-week mark, you still would have made more money. So what this is showing you is that as long as the stock price is increasing, depending on a few variables at play, quite often you are better off using a leveraged position, even if the increase happens within a year, except for if the increase only is fairly small. On the other side of things, because we don't just want to look at the positive cases, if the share price does not move at all, then your 1 times position will make no money, but you won't have lost anything. Whereas your leveraged positions will have incurred costs. Every single one would have incurred costs. And if the share price were to drop, your loss on the leveraged positions will always be greater because of the fees than the unleveraged position. So looking at these kinds of models and thinking about my previous experience, I've started to develop a thesis behind when we might want to use leverage for investing. So a question you might be asking yourself, and some of you might be shaking your fists at the screen now, having lost good deals of money when using leveraged positions or copying PIs who have leveraged positions. Why isn't everyone doing this if it's so great? It seems that as long as stocks are going up, you're making more money than you would otherwise. And the answer is risk. So as an investor, as a trader, you are always trying to balance probabilities of risk, probabilities of reward. And using leverage is always going to be very, very dangerous. It will be more dangerous than not using leverage. And that's because stock prices can very much, always, they can go down and they can stay down. I bet that before Dieselgate for VW, no one would have thought that it was possible that the VW share price was going to tank so hard and stay down for so long. Similarly with airlines now. Airlines were doing very well until the great lockdown, and now their stock prices have been smashed to a third in some cases of their value earlier in the year, and they're going to stay below their all-time high for a long, long time yet. So if you had leveraged positions on those before the stock price dropped, you'd be sitting on those, maybe potentially for years. And that's obviously very dangerous. In that case, you can start incurring fees that will exceed any profit you could reasonably make. It's quite easy to hit stop losses. So eToro creates a stop loss at minus 50%. So if you've got a 2 times leveraged position and the price drops 25%, you're going to hit those stop losses. If you have a 5 times leveraged position, if it drops 10%, you're going to hit that stop loss. It can be incredibly nerve-wracking to hold leveraged positions that are moving tens of percents a day. So, it's good to make money, but you also need to look after your health. And being a nervous wreck your entire life is not going to do you or anyone around you any good. As I mentioned before, higher levels of leverage can see your investment go to zero very quickly. If you have a 10 times leveraged position and that stock moves 2% down, you've lost 20% in unrealized losses. If it moves 10%, you're out. And obviously, the longer you hold, the higher your fees. And it is basically impossible to time the market. Again, you're dealing with probabilities. So the idea being that in order to use leverage, you are going to get it wrong sometimes. But if you get it right more than you get it wrong, there could be a bit of extra reward in store for you. So for me, the approach that I intend to use, and like I said before, I only have one long position that is 2 times leveraged in my whole portfolio of 95 positions at the moment, I will only ever use a maximum leverage of 2 times on any stocks. I will almost always keep less than 3% of my long portfolio leveraged, and probably most of the time less than 1%. I'm literally in a year maybe looking for an uplift of between 1 and 5% from these leveraged positions. And given that my return so far this year has been about 22-23%, I don't need to do very much to increase that. Avoid volatile stocks. So examples would be, don't use leverage on Tesla. You might win sometimes, but you're going to lose a lot of the time too. AMD is highly volatile. Micron is highly volatile. And if you look at stocks beta, you can see how volatile they are compared to the rest of the market. So I would avoid them unless something has massively affected the stock price, and the drop has been unreasonable, and that stock price is almost certain to recover. And you're going to need a lot of patience for entry points. I won't deploy leverage very often. It's probably going to be 2 to 5 times per year. Something might happen. So using Amazon as an example before, if sometimes companies, they deploy a large part of their profit to invest within their business, and this affects their earnings. So if suddenly Apple were to say, we're going to invest 20 billion in R&D to make our company better, it will affect the next earnings report. And a lot of the market will sell off Amazon knowing that the next round of earnings will be lower. But we as investors know that Amazon has a history of taking money, investing it, and improving their business. So that sell-off happens, Amazon loses 10% of their stock price, and that becomes a time when I would consider entering Amazon in a leveraged position. You almost definitely don't want to use leverage right now when the market, almost all of the tech market, is at an all-time high. It's very, very dangerous time right now. All right, so that's about it. Again, I think that there are places where you can use leverage and balance your risk. You need to be incredibly careful. And if you find that you have made a mistake, you're going to want to get out of those positions very, very quickly. So I'm happy to take any questions or opinions. But if you are going to use leverage, please, 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 just be very, very careful with it. All right, cool. Have a good weekend. Speak to everyone soon.